Welcome to the Retiring Real Estate Investor podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to another episode of the Retiring Real Estate Investor. I'm your host, Brandon Bruckman, and I'm very excited to be joined by two folks from the Bonaventure team. I have Dwight Dunton with us, who is actually the founder of Bonaventure, which is really exciting. And Ryan, it's exciting to see you too. I don't want to cut you short either. So Ryan Conroy is here with us as well, who's the Vice President of Capital Markets over there. So guys, thanks for joining me.
Yeah, excited to be here. Thanks for the invite.
Yeah, likewise. I've been meaning to get on this for some time, so I'm glad we finally got this done.
Schedules just for all of us is so difficult. So let's jump right into it. Maybe Dwight, why don't we start with you? Please introduce yourself to the audience, a little background, and really how you got to where you are with Bonaventure.
Yeah. Thanks again for having me, Brandon. I'm excited for the next few minutes to chat with your audience. I'm Dwight Dunton. I'm the CEO and founder of Bonaventure. We are a multifamily investment firm and asset management firm. We manage about $2.5 billion worth of assets. We are vertically integrated. We are the largest investor in our program. So we are first and foremost co-invested with all the individuals and families that have trusted us with their treasure. And we're exclusively multifamily in the Southeast. We've done that in a variety of different formats, and this is our 25th year anniversary. So happy birthday, Bonaventure. But it really just started, for me, our family had owned an apartment building that was previously a farm in the 1960s that our family owned. And in 2000, it reached a crossroads where our partners said it was a terrible property, needed $5 million of capital, and we didn't have $5 million. So Bonaventure was born out of necessity. Turned out I loved everything about the apartment investment business and helping our families, which in turn helping other families. And today, I think we've served about 500 families that have co-invested along with us over the last 25 years.
Oh, that's outstanding. It's outstanding. The invention, the mother of necessity, invents many, many things, does it not?
Yes.
Ryan, give us a little background for listeners as well.
Yeah. So, I've been with Bonaventure for a couple months now. Been in the financial services industry for, well over a decade at this point, which is crazy to say. I started off on the retail side, working with financial advisors, so your side of the fence. And then, last 6.5, 7 years, been in the 1031 DST space, raising capital for another firm. And, more recently, due to some, situations personally with my family, we had a baby, went in a different direction and got introduced to these guys a few months ago and fell in love very quickly. So that's kind of the short answer of how we got here today.
No, that's great. Thanks, Ryan. I want to take it back to the history a little bit and sort of where you are. It's not, I see, Dwight, what's sort of happening in the marketplace. You're acquiring a lot of folks like Ryan to come and build that call it the 1031 exchange, 721 UpREIT vertical for you guys. Maybe walk us back from that about how you sort of got to that place of what seems like a fundamental decision to really attack that marketplace.
It's an interesting journey. So when I started the company, it was our family and then other families, but over time, it's been largely our family. And my father was, very important, like most people's dads, but very important because he just basically said, on the rare occasion that we sell a property, we are not paying taxes. It was like a written law. And so over the last 25 years, out of, again, necessity, we figured out how to use all the tools that the tax code provides real estate investing to defer paying taxes. For instance, we've done over $1 billion worth of 1031 exchanges for our family and our investor group. And so for us deciding to enter into the market where we're providing product through intermediaries such as yourself, Brandon, with team members like Ryan, it really wasn't a big leap of faith for us because we had done this. We had developed that expertise. We had stayed at that Holiday Inn Express and become smarter out of necessity and learning this all ourselves, where we were putting our capital at risk. It was our tax risk that we were taking. And so we developed this deep expertise that's woven into the firm. I think that, for us, the leap was, how do we introduce what we've done to a group of investors via their financial advisors? And folks like Ryan have been in that space for a very long period of time. And so when you find someone like Ryan, who's got the experience and the relationships, but more importantly, shares our cultural values, and then he gets to tell the Bonaventure story, it's like magic. It really is. Like, our story resonates when told by people that share our values and that have the existing relationship and trust with the advisor community.
No, it's really, really well put. And I start to hear things that we like as consumers and diligence officers of sponsors. If you're like, I'm starting to hear operational expertise. I'm starting to hear we did this with our own money first, which is always a great place to start. What from your standpoint really sets Bonaventure apart from others, or what maybe in turn gives you an edge in some of that deep expertise?
Yeah. So, I think Bonaventure is in a class of one, not because no one else owns an apartment building, not because no one else is in the Southeast, but when you put together our three uniques, that we are, one, the largest investor in our programs. So when you're talking to me about alignment of interests, like, we are fully aligned. In our perpetual life fund, which has about 550 million of NAV, we own 130 million. Like, we are pot committed as a co-investor with our investors. So I think it's about participation and alignment. Two, that vertical integration. We are not asset managers in the sense that all we own is Excel. What we have is a team of people.
I'm sorry, that's great. That's a good one.
We have a team of people that they have the ability to manifest the outcome even when the business plan meets an unexpected reality. And so we have people who are involved with construction, property management. We have an internet service provider to drive NOI and provide a better experience for our residents. Like, we have the people that actually can manifest outcomes, versus a lot of investment managers are simple middlemen between somebody's capital and somebody else that knows how to actually make things happen. And I think we're the unique combination of both. And then I think the final thing is our focus on long-term tax efficient compounding. When you bring those three things together, it puts Bonaventure in a class of one. And so that last long-term tax efficient compounding is, we generally are looking for a hold period that's longer than average. We are total return investors rather than IRR driven. We want to make fewer investment decisions because, one, it allows us to make better decisions, and two, it's fewer opportunities to make a mistake. And when you're churning assets, it creates tons of tax leakage. It creates lots of financial friction. You have more opportunities to make more mistakes. Like, if you have more plate appearances, you're going to strike out more often. And so what we want to do is make every plate appearance count by having fewer of them.
That's well put. Talk to us. You mentioned vertical integration a couple times, and I think it has almost buzzwordy context around it at this point. What does it mean to you and Bonaventure?
Well, the first Bonaventure business was our property management company. So again, we came at this as, we are real estate investors, and we needed to build the capabilities to ensure that our family made money no matter what the world served us. And so if we couldn't find a vendor that could do it amazing in the way we needed, we built that capability. And because we couldn't fail because it was our money. Like there was no way that I could go to Thanksgiving dinner and say, hey, I lost my job because I lost all of our investors our money, because that would have been a huge problem. And so to me,
You gotta see at the kids table if that happens, right? Permanently.
I have 4 kids, there's no room. And so when you think about like when it is your money, your family's money, when you're thinking about, man, if I screw this up, I just hurt my children, my children's children, is a different perspective than when you're just managing someone else's money. It raises the bar. And so therefore, you got to be sure, you got to be right. And if you know, the adage is if you want it done right, do it yourself. That it came into play when we were like, we can't find a property management firm that can do it at the level we need done so that we wring every dollar out. We can't find like Cox and Comcast and Verizon, we're not providing great service to our residents. They may not provide great service at your home. And we couldn't find a vendor that we felt could. So we built an internet service provider from the ground up to provide the best internet experience for our customers. And so we don't build that vertical integration just so that I can put it on the cover of our brochure and I can tell you right now, Brandon. It was about driving returns and reducing volatility in returns when we couldn't find a vendor that met our standards.
That is the true definition of vertical integration, as opposed to the buzzwords for it. Talk to me a little bit about how you view debt. So one of the things Ryan and I pre-talked about was a little bit is you view debt as an asset, not a liability. Talk us through that.
Yeah, I think, to me, debt is a magnifying glass. And, when you're being pitched an investment and it's an apartment building or a self-storage building or whatever, and the cap rate on the asset is a 5.5, but the projected IRR is 20. Somewhere there's a magnifying glass in order to infuse risk in order to have the chance to raise the return. And a lot of ways that's done is with debt. And so for us, that is a liability. However, when we look at debt, we say, okay, we're not using it as a fulcrum to infuse risk to drive returns. What we're using it as is a way to minimize our downside. And so when rates were really low in 2021, we backed the truck up and we borrowed money for the next 40 years on a lot of assets at 2 and 3%. And so today, when you look at those liabilities, the net present value of those liabilities is actually an asset. And our cash flow, our debt service coverage ratio is through the roof. And so I think we look at it as a strategic tool rather than a way to juice IRRs. And when viewed from that perspective, it's a strategic tool. It could be a weapon of mass destruction if used imprecisely. It changes the relationship and perspective with debt. And so we really look at how do we use debt to minimize our downside, and that's from fixed rate, long-term debt. That is our perspective. That will help protect the downside. And when rates are really, really cheap, we'd rather go long. And to us, when Fed funds were at 25 basis points, we thought it was a pretty safe bet to go the direction they're likely to go is up rather than down. And so it was a really simple thing. And today, our investors are so thankful that we made that decision. Yes, we could have saved like 25 or 30 basis points for about a year by going with a floating rate loan. But today we'd be 400 basis points underwater if we'd gone floating versus locking in fixed. And so it's become an asset in our portfolio. And I think our approach to long-term fixed rate financing has probably, cost us a few basis points of return during the falling interest rate environments. But what it did was it gave us a rock solid, consistent forecast, no volatility.
Will we ever see those rates again? Maybe not at all.
I don't make forecasts about the future, especially about things I have no control over. And, I think we can all watch the tweets going on from all the various talking heads in our government about rates should go up or down, or the Federal Reserve Chairman will or won't do things. And so we just want to remove that risk entirely because we have zero control over it. And so, it'd be nice to have rates go down, But what I find in life is that most people's what they hope for or what they expect to happen coincides with what would be good for their business. And we avoid that at all costs because that is dangerous when you talk yourself into believing a future that happens to coincide with what you need to have happen or what would be good for you. And so I just say, I have no idea what way interest rates are going because we went fixed. We don't care.
Yeah, it's one of the things that makes us sort of nervous about the current state of affairs is what we see in the real estate space of folks expecting or anticipating rate cuts and needing that, frankly, to stay alive. That doesn't sound like good math to us, or makes us very frightened.
Hope is not a business plan.
No, not a great strategy. What did you want to add there, Ryan? Sorry.
I was going to say, when I was, talking with Dwight and his team during my interviews, and we were going through their portfolios, and they're going down. This is 2.3% interest rate that amortizes till 2060. I mean, it was a no-brainer. These guys are doing something different here, so that's a big selling point for me.
And it coincides with the strategy you discussed as well of holding those assets for the long term. You certainly do that, those rates, without a problem. Talk to us about the current marketplace. I mean, you're a multifamily focused firm in the Southeast. We've seen a lot of disruption there in terms of, generally speaking, oversupply, not the same kind of rent increases we're expecting. Expenses are more expensive. How do you view the current market? Is there opportunities there? Are you waiting? What's the current state of play in multifamily, particularly in the Southeast?
Yeah. If you'd asked me for one word, I would say super exciting, which is hyphenated. So maybe it's two words, but
I'll allow it.
Unfortunately, the investor psychology is buy high and sell low. And so in 2021, when asset pricing was ballooning, people could not get enough of the Southeast. And capital charged down there. And when there weren't enough existing apartments to buy, they're like, let's build more. And while the Southeast has great economic fundamentals, like the reality is like there are not enough people to absorb that in an orderly fashion. And so the rate reductions, in terms of rental rates, the occupancy reductions, is just math. It was obvious that it was coming. So we didn't buy in those markets. We had very little exposure to those boom markets because not only were they booming with people moving there, but they're booming with capital to build the next units. And so I'm excited because there is a ton of opportunity to buy great assets in markets that have wonderful fundamentals, except for too much supply. Everything else about the market is really exciting. And so we want to buy when it feels really uncomfortable, like when it feels scary. That's usually the best time to buy. We want to sell when there's euphoria. My dad said, when there's blood in the street, someone needs to mop up, and we want to always own a mop. And so I think that opportunity is here. We're much closer to the bottom now, and it still feels kind of uncomfortable. So that's the time to start buying. And I'm not a market timer, but I can say I feel very comfortable that buying at these levels has a way better risk reward trade-off than buying at the levels 2 and 3 years ago when you're buying at 3 caps. The amount of rent growth you needed to have in order to just be able to get to even if rates reverse to a 5 cap was like 60%.
Mm-hmm. Mm-hmm.
Just seemed mathematically unlikely. And so we just said that doesn't make sense. And today, if I can buy an asset at a 5 cap after rents have fallen 25 basis points at a cost per unit that's 25% below what the last guy built and 15% what the replacement cost is, that starts to look very interesting.
Gotcha. No, that makes sense. Do you feel like there's a line though waiting for those assets? Like there's still a lot of mops out there to scoop those assets up?
I do think that, there's always distressed funds raised, but and a lot of those are looking for RTC days in terms of discounts, where assets are trading at 20 cents on the dollar. And so they end up having to wait, and we're probably not going to have, it's unlikely it'll get that bad. So I'd rather earn a fair return at a low basis and make a few really good investments than hold on and go, this has got to be a grand slam or else I'm not going to deploy. And I think that's largely the disconnect between the capital that's available and the pricing that owners are willing to accept is the capital that's available is still holding out for like walk-off grand slam type returns. And maybe we're in a situation where 2 years ago, there was a wide gap between a bunt single and what they were selling. Today, I think we can buy assets that is a stand-up double or a stand-up triple. It's not a grand slam. Maybe there's a few of them out there, but that's good. Base runners win games.
That's right. Yeah, that's another buzzword that makes me giggle is distressed. I'm like, you know what? I lived through, and I'm sure both of you guys did too, lived through 08, 09. That was distressed, right? This is just an adjustment in price. This is not.
I refer to the current climate as discomfort.
There you go. Yeah, that's more accurate. Not as flashy when you put it on the name of a fund, the discomfort fund, but it's more accurate.
Ryan, why don't you take that out to 10 clients and see what they think of the Bonaventure Discomfort Fund?
They're going to think I need some Pepto-Bismol or something. Yeah.
There's some indigestion in the marketplace, but only mild indigestion.
Yeah. It's more.
But that's not to say there are some situations that are distressed, but it's not epidemic. A lot of people are in discomfort, and their business plan is hoping for these rate cuts so that they can roll their assets. They're hoping for the market absorption to happen. And, I think they're running out of rope, and they need either rates to fall or NOIs to rise in order to continue to be the owner of those assets. Other people are like, you know what? Doesn't matter how long I own these assets for. I'm never going to earn or promote. So let's sell these today and start the IRR clock over by doing another deal. It's not super rational for their investors but it is very rational for the sponsor to do because their business is earning promotes and fees. And so if their current vintage of assets have no chance of earning promotes, they should just they want to terminate those and start all over. And there was a series called Dallas back in the 80s, and they killed off one of the characters and ratings tanked. And so the next season they brought him back, and their plot line was, it was just a dream for his wife. The whole season was a dream. And so I think that's really what those sponsors are going to do is they're going to kill off this entire vintage, and they're going to go, that was just a bad dream. Let's talk about these new deals we're going to do.
Yeah, that makes my head spin, frankly. From the investor perspective, it causes pain. That causes
for sure.
That's the discomfort fund. I don't like that. And that's what you mean, though. I mean, that's where the misalignment lives, right? You can't do that from your perspective, nor would you want to, because you own the assets.
Yeah, and really, while our dollar-wise, we are the biggest investor. We own tons of hard assets. Our most important asset is our reputation. And even if you set aside the financial hit that we would take as being co-invested, it's taken us 25 years to build our reputation. It will take one bad decision to ruin it. And I still have a lot of years ahead of me. I don't know that I have enough time to rebuild a 25-year reputation. So that is our most valuable asset, and making those decisions that are short-termed are not ones that we're willing to make.
Like that. Absolutely true. Talk to me about the debt situation. So we talked about there may be some opportunities for potentially distressed. Don't tell anyone. Yep. Shh, quiet. Do those live really with bank and bank financing, where we've done the extend and pretend thing for a while now? Are banks out of that rope and don't have the kind of capacity or willingness to do that anymore? Where are they at?
Yeah, so there's not a ton of foreclosures or note sales as a percentage. Really what it is the bank says, we're not going to extend, you need to roll this loan somewhere. And that requires either an equity ejection for the current sponsor to right size the loan, or they have to sell it to the next buyer, who basically resets the value on the asset and then gets a 70% loan on that new value. And so I think that's really where we are, is the bank is not underwater. The bank is just out of patience. There are a few deals where the bank is underwater that the sponsor can't sell it for more than the balance. And those are probably going to be note sales. And you're going to have the buyer of the note either be a loan to own, or they're going to strike a deal with the existing sponsor to say, all right, put some cash in, we'll put some money in a B note and we'll figure it out.
Mhm.
But it's largely what I've seen is the banks just say, we're done. You need to give us our money back. And that forces the sponsor to get an equity injection at a new mark, or they have to sell it. And the good news is investment sales market transaction pace is coming back somewhat, but it's nowhere close to where it was at the peak in 21 and 22.
It's a fun little game that's kind of happening, right, between buyers and sellers, and this probably plays out for probably an extended period of time. Let me shift both of you, and then Ryan, love you to jump in on this too. And not talking about any specific product, just so we're clear, but regulators, you listening? Talk to us about just the platform in general. Maybe some of the advantages and disadvantages as you see it with going the traditional call it traditional DST route versus going the DST 721 UpREIT route, and kind of the decisions that you guys made as a firm to kind of go down the second path instead of the first.
So I think that unfortunately, the way the IRS gave the private letter ruling on the DSTs set up an environment that creates a situation where the sponsors of these transactions need to earn their fees upfront in terms of a commission, a fee to the sponsor, and it's buyer beware that if things don't go well, that's all borne by the investor. And I don't think that's the sponsor's fault. I don't think we have people who are nefarious, but unfortunately, that was the rules as they were set up. And that is not how traditional LP investing is done, where you have a sponsor who's the GP and LP. There's usually a tremendous alignment of interests where as the deal does better and better, everybody wins. And if the deal doesn't perform, the sponsor isn't getting rich on the back of the LPs.
Mm-hmm.
And so I think that's been the current environment, not because sponsors want it that way. The IRS just kind of set the rules of the game. I think that's a big problem with the current DST structure is it misaligns the sponsor and the investor. Where I think that can be improved is when there's a DST to 721 exit, because then the sponsor does not need to earn all their fees one time at the initial transaction, but rather can get the investor's capital into a fund of some sort that can be managed, and there can be a better alignment of interests between the investor and the sponsor, that when the investor wins, so does the sponsor. And if the investor doesn't win, the sponsor doesn't get a windfall. And to me, I think that is probably the most important opportunity of the advent of the DST to that UpREIT transaction. I believe it is a better alignment, a better exit for many investors. Now, it's not perfect for everybody, but I think that cures one of the biggest misalignments in the current environment. I also think that there's some other benefits for the sponsors about diversification.
Mm-hmm.
Some investors are not looking to continue to 1031 exchange repeatedly. They're at a point in their life where this is an asset allocation decision rather than a property specific decision. And so it gives them some diversification. And so I think there's some benefits for certain investors of why a 721 exit might be better than rolling again into the next 1031 exchange. But I do think fundamentally it gives an opportunity to get that alignment, which I think the industry is sorely in need of, because if you assume everybody has good intentions as a sponsor, sometimes the market hands you a surprise and assets go down in value, and those sponsors already made their money. And unfortunately, the investors are the ones on the losing end. At least if there was a way to align interests, the sponsor would say, you know what, that didn't perform for whatever reason, but we didn't make money in spite of you.
Yeah, Ryan, what would you add there? I mean, you've been in this space for a minute.
Yeah, it's been an interesting ride for sure. I started in this industry, in this side of the business, 1031 DSTs in 2019. So, I got the 2019 days were fairly normal for the most part. Property values are slowly rising, and then COVID happened, and none of us knew if we're going to keep jobs. Nobody knew what was going to affect the real estate world. And then you had the huge just burst of business happening in 21 and 22. Where I didn't have to answer, I just had to answer phone calls. There's so many transactions happening. And so unfortunately, a lot of sponsors, had to make decisions to get some product. There was a need out there for you. And so that what was nice to hear from Dwight was talking through that environment. And I think you mentioned earlier on this was just how they approached that, that time period of being very prudent and, not putting out a deal out there that he wouldn't invest himself, aligning themselves with investors. Another aspect that I want to talk about the platform as well is diversification. These guys are very open-minded and always trying to find a way to help investors. And so sometimes, a beauty of joining this firm that I really love is they're not always going to ask me to fit a square in a circle hole. Dwight and his team are very open. They want to hear feedback from advisors and clients throughout the markets of what the need is, what, interesting things are out there. And if it's something feasible that they can do, they'll certainly put it together. So their open-mindedness and diversification on the platform, not causing me to be a one-trick pony, was something that was, checked all my boxes, so to say. And their alignment from start to finish, the way they think about the underwriting, looking at the properties, it was one of one, as Dwight mentioned earlier in the call. So that's why I'm here. I think these guys are going to do some great things. The word's starting to get out about Bonaventure, and so I think you'll be seeing a lot more from us moving forward.
Good points, guys. I'm going to reach behind me and grab my soapbox because I have a lot of things to say about this that are not making me happy. Something needs to fundamentally change in our space. So, we just went through the math with a rather younger investor about what would it look like if, and more sophisticated, what would it look like if they rolled DST, traditional DST, 3, 4, 5 times over the course of their life. And I don't need to tell you guys what happens if we don't get a decent amount or a significant amount of property appreciation. Their total returns can get sucked up by fees every time we roll that DST. That's the facts. And we just don't see drastic price appreciation in these assets over time. We're just not going to. I don't know how you do that, right? And then, Dwight, to your point, man, that's a condition, something we can't really control about what environment we're kind of staring into in a 5, 7, 10-year time frame. We don't know, but we know that we're going to churn that because of the incentive model. The incentive model is to churn deals so that I can make fees as a sponsor. That's what it is. They're not making money holding assets. They make money when we churn them. And so that's to kind of your point too, Ryan, about we sort of subdivide the world into 2 different sponsor types. It's one that has to do deals and meets demand with deals that maybe we find are substandard, and others that choose to fundamentally not do deals because they don't see the deals to do, right? And one is usually bigger than the other. One is frankly more successful, makes more money than the other. But you can guess which one we like and which one that we look at sideways. And it's the way the model and the structure is set up. So we're drastically looking for something needs to change. And it sounds like you guys think and look at it the same way maybe that we do as well. We need better alignment. We need better product. We need better fee structures, and we need it now. And we need people to stop doing naughty stuff, right? We're talking on August 28th, and there's issues out there, and they're bad. We don't need to delve into those details, but we need that stuff to stop. Otherwise, this industry is never going to grow because frankly, it's just not as big as it could be. We talk about we'll maybe do $7.5 billion this year in capital in the space, and everyone's going to cheer for that. And I'm going to cry because it's not even close to what the size of this could be at all, right? And it's for all the reasons I just mentioned. So if you guys want to jump on that and want to borrow my soapbox, go ahead and keep complaining about this. But these are the problems that frankly, we're stuck with as a firm day to day facing our clients about how do we navigate the space. And it is frustrating.
Yeah, I think it is. And, I do think it's, part of it is the rules set up by the IRS that govern this. But to me, those rules are not a straitjacket. They're like a fence around a large pasture. And so as long as we don't run into that fence, there's a lot of room to operate as a sponsor. And I think it requires everybody to really look at what our fundamental goals here. And it's about servicing individuals and families. It's about helping them build wealth for their future. And if we keep that in mind, I think the innovations will take care of themselves. We're going to figure out how to deliver on that promise that we all make to those families and investors. Mm-hmm. And, I think a perfect example of this is with a DST, you can't really do a value add transaction. And so we're relying on market appreciation to overcome the fees. And so like that's really hard to do. And a lot of it is luck and timing. But if we can move that capital into a vehicle that doesn't have that straitjacket of no value add, no investments, all of a sudden it gives a firm like Bonaventure lots of tools to drive total return, because like we can outperform the sub-market because we're able to invest marginal capital to replace that Formica and put in granite. We can add services that drive NOI, and so it gives us a much greater chance of driving NOI, which ultimately drives asset values. And those are the types of innovations and I think perspective that the market needs to just kind of like start with a blank piece of paper and say, how do we drive total return for investors? And how do we work within the constraints set up by the government in order to achieve that for investors? I think if we focus on the investors, their families, and their futures, we're going to solve it all.
Mm-hmm. Amen. And allowing, I wouldn't mind moving those fences either. Like, who says those fences have to be where they are, right? Let's go back and move the fences to allow operators like yourselves to do what you need to do to add value and to protect investor capital. Like, what's bad about that?
Yeah, I would say that, the regulatory environment is today looking at a lot of the existing rules and go, does this make sense for that? And so maybe there's a shot to sit down with the powers that be and say, hey, some of these rules have had unintended consequences that are bad for consumers. If we can tweak or modify those, we could accomplish the goals that I think the rules were set up in order to protect consumers and ended up hurting them.
This is starting to sound like a fun little side project to work on, or main project.
Well, so out my window is the Potomac River, and across the river is Washington, D.C. So I'm probably geographically suitable for that. I'm not necessarily politically connected, but anyone that's watching that is, I'd be happy to meet you on Capitol Hill. I can take an Uber.
There we go. Dwight to spearheading. I'm just writing this down. Got it. Okay. We'll find the right political people to make it happen.
Yep.
But yeah, I mean, these are real problems that honestly, like, I just feel like we're dodging bullets every day. We're trying to, and I don't want to feel that way anymore. There's better ways for us to do this. Let's find them. I think you guys are starting that a little bit here. What didn't I ask? What do you guys want to add?
I mean, I think that real estate investing, setting aside tax motivated investing, but real estate investing can be a huge part of people's financial future. And, our family has built hundreds of millions of dollars of wealth through investing in boring stuff. They're not chips made in a fab halfway around the world. They're places that we all drive by every day. Everyone understands the need to have a roof over your head. And I think that can be part about building a financial future, one that you can actually sleep at night because you understand it fundamentally. And I think for a lot of investors and their advisors, like helping not only get total return, but the anxiety that goes along with the volatility of the public markets, real estate can help cure both of them, produce total return and reduce volatility. And so I think there's lots of formats for doing that. And I think folks like you who are informed to help and connect investors and help them see that this can be part of their overall financial portfolio is really important. And we want to work with you and your colleagues to help share our experiences and open more investors to the ability to invest in institutional quality real estate. They don't need to deal with the terrible teas of toilets, trash, and tenants. You find firms like ours and lots of our high quality competitors to do that on their behalf, and they can get the financial benefits that come through the diversification of investing with real estate.
Awesome. Ryan, how about you? Anything you want to add?
No, I think we've hit it on the head. I agree with you. This industry should be bigger than it is. So I think, it'll be an interesting next couple of years, especially with firms like Bonaventure coming in, some new firms and doing some unique things, seeing more, integration, so say, and innovation, I guess is the best word. So I think the next few years will be very interesting to see how the DST and 721 space shakes out. There's a lot of people taking advantage of just the volume flow the last few years and not taking the time to educate on products and really all the risks involved in fees and all that goes into them. So I think there's a lot of sponsors that are changing that moving forward. I think the industry will continue to grow. but there's so much room for opportunity for all of us.
Yeah, absolutely. I'll end on a positive note. So when we started when we started in this space, you could count the RAs on my hand that were doing significant volume in this space. That has changed, and that's a very, very good thing. That makes me very optimistic. We'd like to see more RAs doing this. We're partnering with other RA firms to bring them into the space where they don't have the capabilities or willingness to launch this as a separate sort of business line. We're there to partner with those folks, and so we want more like-minded folks that are fiduciary in nature to come here, and it's happening. So that's a really good thing. So maybe the wheels of change move slow, like they do across that Potomac River occasionally, right? That you get to look at, Dwight. So we'll keep being hopeful and optimistic that keep focusing on investor, like you guys said, and then the innovation will follow. I want to thank both of you guys for joining us today. It's an awesome conversation. Where can I point folks to find you? We'll link all that up in the show notes. What's the easiest place for them to learn more about Bonaventure?
Bonaventure.com. Super easy.
Simple. Our listeners will be able to figure that out. I have faith in them. They're a sophisticated group. Guys, thank you again. Audience, until next time, we'll see you. And thanks for listening.
Thanks for having us.
Thank you, guys.
Thanks, Brandon.